We're talking about tax planning strategies. How can you save money on your taxes, reducing your tax bill or increasing your tax refund? And specifically in this video, we'll talk about the timing strategy, why it works, and how you, when you understand this strategy, can save money on your taxes this year. So, hi, I'm Steve Hunt. I am a certified public accountant, and I'm the consultant for prosperity and adventure. I'm the expert at helping people like you to reach your dreams faster. I'm also the owner of collegetaxrefunds.com, where we help recent college students and their parents and families claim thousands of dollars that they don't even realize they missed on their old tax returns. So if you have a recent college student in your family, please have them check out collegetaxrefunds.com to see if they missed any money on their prior few years of taxes that we can help them claim. So today, as I said, we're talking about tax planning strategies. And yes, we're going to name and look at a few of these strategies so that you can use them if you'd like to in your business or on your personal taxes to save money. But specifically, I want to help you understand why tax planning strategies work so that you can look for them, create them, think them up on your own. And so today we're talking about the timing strategy. Now, if you haven't already watched my overview video talking about tax planning strategies and why they're important, please check out that video. This is a part of a 4-part series of videos where I'm looking at 3 different strategies for saving money on your taxes. Again, today we're talking about the timing strategy. So the timing strategy is probably the tax planning strategy that you're already a little bit familiar with. It's the general idea that not all tax years are created equally. Some tax years are better than others, as in some tax years have lower tax rates than other tax years. And so if you want to receive income and pay taxes on that income in a year when the tax rate is lower. And if you want to reduce your income by using more expenses and more deductions on a tax return in a year when the tax rates are higher. So that's the general idea behind timing, is figuring out which years are better for my income and are better for my deductions. It's one general rule about paying any expense is it's usually better to pay later than to pay now. I mean, most of us, if we could have the choice, would prefer to have something now and pay for it later. And I'm not talking about what that means for your credit or what that means for interest. I'm just saying if you had the choice to pay later and there was no interest involved and there was no, damage to your credit, we'd all choose to pay later. So if you have the choice between having income reported on your taxes this year or having that same income reported on your taxes next year, usually you want to report it next year unless, as I said, the tax rates are higher. So let's take a look at what this strategy involves, okay? And the first part is accelerating or deferring your deductions or your expenses. Now, this only works if you're a cash basis taxpayer, which means that you basically report your income and your expenses when the cash comes in or the cash goes out. The other type of taxpayer, some businesses, are on the accrual basis. This means that they don't report their income and expenses when the cash comes in and goes out. They report it when they perform the service. That's when they report the income, and they report the expense when they use up the service. And even if the money doesn't come in until a few months later, they're still going to report the income when they did the service. And even if the money doesn't actually go out and get paid to their vendors or suppliers until later, they're still going to report the expense when they acquired or used up the service. That's called an accrual basis taxpayer. Some of you may have businesses that do that. These timing strategies are not going to work as well if you are an accrual basis taxpayer. So we're talking about taxpayers, normally like individuals or smaller businesses, sole proprietorships, and maybe some smaller corporations that use cash basis tax methods. And so they are going to have some control over what year to recognize their income on their taxes and what year to deduct their expenses. So sometimes, though, you want to accelerate your accelerate your deductions, which means take them early as soon as possible in this year instead of next year. And sometimes you want to defer your deductions, which means wait to spend the money until next year. Again, that depends on which year is going to have the higher tax rate. So if you're going to have a higher tax rate this year, let's take all the deductions we can and save more money. If our tax rate is 30%, for example, then that means every dollar we spend and deduct on our taxes saves us 30 cents. If our tax rate is only 10%, then every dollar that we spend and deduct on our taxes will only save us 10 cents in our taxes. So we want to take the deductions in the year that has the highest tax rate. If this year is the year with the highest tax rates, let's take the deductions right now. Now, if both years are going to have the same tax rate, then as we've said, it's better to pay tax later. So let's take the deductions right now to reduce our tax this year. So that's accelerating your deductions. But once again, if next year's rate is going to be higher, then you'll want to push those deductions into next year and defer them. Let's talk about some examples of that. So one example is prepaying, or the opposite would be waiting to pay some of these expenses, like your rent. If you normally pay your rent on January 1st, you could prepay it on December 31st. And by doing this one simple deduction, you're going to save money on your taxes this year instead of next year. That does probably mean your taxes might be higher next year. But again, if your tax rate is lower next year, let's go ahead and take the rent expense now. The same for utilities. We can prepay those utilities for January right now, or we could prepay the insurance that's going to come due in January or February right now. And we can also prepay our employees. Maybe we're planning to bonus them at the end of the year in January. Well, we could give them an early bonus for the holidays that they'd be very grateful for, and we get to deduct it now and save on tax now. Now again, you don't want to do any of this if next year's tax rate is going to be higher, and so you want to pick the right year. So maybe if we have a utility bill coming due at the end of December, maybe let's pay that in early January to take the deduction next year. The same with our bonuses. Let's pay our bonuses next year if we think that our our tax rate will be higher next year. Now, charity is something that you can do. So that the rent, utilities, insurance, and bonuses are all things if you're running a business, maybe a small corporation or a sole proprietorship. But if you're not running a business, one way you can still save on your taxes is if you itemize your deductions, or if you haven't paid any charity at all during the year, you might want to pay a charitable expense right now in this year if you're trying to reduce your income just a little bit. So under the current tax code, everybody can take up to $300 of charitable deduction on their taxes. And so if you didn't give any money to charity all year, you might at the end of the year think about giving away that $300, especially if you're planning to do it anyway in January, but you want to save on money this year. And then medical expenses. Now, medical expenses and charity are both expenses that you can deduct more of if you're itemizing your deductions. A lot of people don't itemize their deductions anymore because the standard deduction is so high. So for a married filing jointly couple filing their taxes together, they get a $24,000 plus deduction, which means that before you can itemize your deductions and have it make sense, you got to have things like mortgage interest, taxes, charity, and medical bills all add up to well over $24,000. And a lot of married couples with your middle income married couples don't have enough of those expenses to get over $24,000 and itemize their deductions. But one way to get there is with the timing method. That means waiting to take some of your charitable deductions and some of your medical expenses in a year when you can bunch them all together. So let's say you've already had a bunch of medical expenses this year. Go ahead and this year also prepay some of your taxes if you can. Prepay your charity, pay a lot more in charity. And if there are other medical expenses that you know are coming up early next year, try to pay them now. Maybe prepay the doctor or even have the medical expense happen right now. And so you bunch up all your charity, all your medical, all your taxes into 1 year so that they get above the $24,000 standard deduction. And this way, you can take a $28,000 itemized deduction or a $30,000 itemized deduction. That saves you on tax this year. And then you might say, yeah, but then I won't have any charity to pay next year. I won't have any medical for next year. I won't have any taxes for next year. Well, so what? You get the $24,000 standard deduction next year, which you would have gotten every single year anyway. So the point is, if you're not itemizing deductions, you're getting $24,000 every single year. But if you bunch up your itemized deductions so that they happen every other year, so for example, let's say you're in the habit of paying 10% of your income to your church for tithing. then instead of paying 10% every single year and that number never gets over $24,000 and you never get to itemize your deductions and you never get a tax benefit for paying that charity, go ahead and pay your 10% every other year. So this year, save up all your 10% and wait and pay it next year on January 1st. Then next year, pay all your 10% to charity all next year, so that you're actually paying all of this year's tithing and all of next year's tithing in the same year. So every other year you pay your tithing, and in those same years you try to do all your medical expenses and all of your taxes. This is the timing method, where you're using the years to your advantages because some tax years are better than others. I've also put on this slide here the idea that you could prepay your CPA. You know you're going to have to pay your CPA to do your taxes in the early next year. So why don't you, get together with your CPA in November, December, do some tax planning with them, and go ahead and pay them in advance for the tax work that they're going to do in the next few months. And that way you get the deduction this year. So those are some of the ways that you can accelerate and defer your deductions if you're cash basis. We're going to keep going, talking about some more of these methods. You can also purchase equipment this year or wait to purchase equipment, appliances, or assets. Let's say your rental property needs new appliances. Let's say that your business needs a new truck and other assets, like a new desk for your business. If you have a lot of money this year and a high tax rate this year, buy those things this year before the end of the year. And if you have low income this year or a low tax rate, then wait and buy them next year. All right, let's keep going and talk about deferring or accelerating your income. We've been talking about accelerating and deferring your expenses, but you can also, if you are a cash basis taxpayer, you can push back or accelerate the income. So why would you ever want to accelerate your income into this year? Like, as in, try and get more income this year and less next year. Once again, remember that if your tax rate is lower this year, then this is going to be the year that we want to pay the tax, and we want to accelerate that income. So what are some examples of accelerating income? So one of them might be if you ask your customers to pay early. You might entice them, give them a discount if they'll pay in December instead of January, because you want the income now on your taxes. Now, the opposite is true if next year's tax rate is going to be lower and you want this year's income to go down. Then ask your customers to please wait to pay. Tell them that you're not going to charge them any interest or any penalties if they wait until January to pay. Another way to accelerate or defer your income is to put money into, or even withdraw from, or a rollover, basically playing around with your IRA or your 401k. Now, this doesn't just move taxable income from this year to next year. This is a tax planning strategy, a timing strategy that can move taxable income from this year way out into the future when you retire. So let's say that instead of taking $6,000 in your taxable income this year when your income is high, you decide you're going to put that $6,000 into your 401k or your IRA, and you're going to wait and pay the tax on it and all of the growth that it will make over the many years. And you're going to wait and pay the tax when you retire, some 20 or 10 or whatever, 30 years from now. And maybe your tax rate will be lower then. But even if your tax rate's not lower then, this still is a good strategy because of, look at the top of the slide where it says the present value. Wouldn't you rather pay your tax later? So if you have the money to go ahead and invest in for your retirement, put it in your 401k and wait to pay the tax for years to come. Now, as I've said already, you may want to accelerate your income. So it's possible that you want to pay the tax right now and not wait to pay it when you retire. For example, let's say that your tax rates are really low right now. Your income's pretty low, and you feel like when you retire, you're going to have a much higher tax rate because you're going to be making a lot more money when you retire. Then this would be a good year to accelerate and to not put that money in a regular 401k, a traditional 401k or IRA. Let's put it in a Roth 401k or IRA. That means let's pay the tax right now, then put it away for the retirement. And when it comes out of the Roth 401k or IRA, we don't have to pay tax on it. This is a timing strategy for reducing your overall taxes and paying less money to Uncle Sam, which again allows you to increase your after-tax wealth. Now, one other thing that you might do is if you know that, whoa, this is a really bad year. It's a bad year for the economy. It was a bad year for my checkbook. I lost my job, don't have a lot of income. This is a good year then when your tax rates are going to be low for you to take money out of your traditional 401k or IRA and roll it over into your Roth. So you know that you're in a 10% bracket instead of a 25 or 35 or whatever bracket for taxes. You take $100,000 or $25,000. Just talk to your tax advisor and determine how much is the right amount. Take money out of your traditional IRA, pay the tax on it this year when your taxes are low, and put it into your Roth IRA for when you retire. And this is a strategy, a timing strategy. Recently, we had the coronavirus pandemic, and there was across the country a permission granted for people to take money out of their retirement accounts and not be penalized. So they'll pay the tax on that money, but they won't pay a penalty because they took it out early because of the coronavirus pandemic. Now, you might also live in another disaster area where this happens to you more often for like a hurricane or fires or things like that. If you have been permitted to take money out of your traditional retirement account and pay the tax on it but no penalty, there's usually a provision where you can decide whether you want to pay the tax all this year or over the next 3 years. Once again, this is a timing strategy to consider. Do I want to pay tax all this year, maybe because my tax rate's really low? Or will it be better to pay the tax over the next 3 years because I would rather pay the tax later than pay it now? Again, these are timing strategies to consider and to talk to your tax accountant about. Another strategy would be whether you sell your capital gains stocks or other investment properties right now this year, or whether you wait to sell them next year. Again, you want to sometimes accelerate your income into this year if your tax rate is low this year, and sometimes you want to defer your income into next year if your tax rate is lower next year. Now, if you have loss stocks or property that has lost money, sometimes you want to try to sell it right now and recognize that loss in the same year as you have gains, so the losses offset the gains. Or maybe you don't want to sell the loss this year because you don't have any gains this year, but if you wait till next year, you can sell your losses and your gains together. Now, definitely there's some risks involved when you decide, I think I'll wait to sell the stock until next year. You don't know if it's going to go up or down between now and then, and so it could change everything. But you still want to talk to your tax advisor about whether or not you should sell those gains or losses on your investments this year or next year, because you're trying to figure out which year is best. And then the final example I've given up here, the fun one, about having a baby early. So instead of waiting until January 1st to have that baby that's due on January 1st, which would be just a terrible tax consequence, because what it means is you don't get to claim that baby on your tax return this year. You've had that baby, gestating for 9 months, and you've had the expenses of getting ready for that baby, but you don't get to claim the baby as a dependent. You don't get to claim the child tax credit. If your income is low enough, you won't get the earned income credit for that child. And so literally you could be out $3,000, $4,000, $5,000 or more on your taxes this year just because the baby was born January 1st instead of December 31st. So if you are due to have a new baby in the first week or so of the new year, talk to your doctor, maybe talk to your accountant, and consider the possibility and the wisdom of inducing the baby early, having that baby in the last few days of December. Again, this is called the timing strategy for lowering your taxes, and it's all about what year you have income and expenses. And if you're a cash basis taxpayer, an individual or a small business that reports your income and your expenses based on when the cash goes out or comes in, then there are many strategies you can do to push the income or the expenses into next year, or to pull the income or expenses into this year, or push them far off into the future. So this was our first tax planning strategy. We're going to do a couple more videos about other tax planning strategies. Please subscribe, and so you'll get notified of those videos. And also put your comments or your questions about taxes, tax planning in the comments below. Thank you so much for watching the video and for sharing and liking. Have a great day.